Chapter 7. Reporting and interpreting costs of goods sold and inventory. The primary goals of inventory management are to have sufficient quantities of high-quality inventory available to serve customers' needs, while minimizing the costs of carrying inventory, such as production, storage, obsolescence, and financing. Low-quality inventory leads to customer dissatisfaction, returns, and decline in future sales. Also, purchasing or producing too few units can cause stockouts that mean lost sales revenue and decreased customer satisfaction. Conversely, purchasing too many units increases storage costs as well as interest costs to finance the purchases. It may even lead to losses if the merchandise cannot be sold at normal prices. Inventory is tangible property held for sale in the normal course of business or used in producing goods or services for sale. The following are types of inventory. Merchandise inventory includes goods held for resale in the normal course of business. The goods usually are acquired in a finished condition and are ready for sale without further processing. Raw materials inventory includes items acquired for processing into finished goods. Work-in-process inventory includes goods in the process of being manufactured but not yet complete. Finished goods inventory includes manufactured goods that are complete and ready for sale. The cost principle requires that inventory be recorded at the price paid or the consideration given. Inventory cost includes the sum of the costs incurred in bringing an article to usable or saleable condition and location. In addition to the invoice cost, other common costs included in inventory are freight costs, inspection costs, and preparation costs. In general, the company should cease accumulating costs in inventory when the raw materials are ready for use or when the merchandise inventory is ready for shipment. Any additional costs related to selling the inventory, such as marketing costs and salaries, are incurred after the inventory is ready for use. So, they should be included in selling, general, and administrative expenses in the period they were incurred. Part 1. A merchandiser purchases inventory that is in ready-to-sell condition. When merchandise inventory is purchased, the merchandise inventory account is increased. When the goods are sold, costs of goods sold is increased, and merchandise inventory is decreased. Part 2. The flow of inventory for a manufacturer is more complex. First, a manufacturer purchases raw materials for use in making inventory. The items and their costs are included in raw materials inventory until they are used, at which point they become part of work-in-process inventory. As goods are manufactured, two other costs of manufacturing, direct labor and factory overhead, are also added. Direct labor refers to earnings of employees who work directly on the products being manufactured. Factory overhead includes manufacturing costs, such as the costs of heat, light, and power to operate the factory. When the inventory is complete and ready for sale, the related amounts of work-in-process inventory are transferred to finished goods inventory. When the goods are sold, cost of goods sold is increased and merchandise inventory is decreased. Part 1. Cost of goods sold is an expense account. Cost of goods sold is calculated by multiplying the number of units sold by their unit costs. Let's examine the relationship between cost of goods sold on the income statement and inventory on the balance sheet. First, each accounting period is started with a stock of inventory called beginning inventory. During the accounting period, new purchases are added to inventory. The sum of the two amounts is the goods available for sale during that period. What remains unsold at the end of the period becomes ending inventory on the balance sheet. The portion of goods available for sale that is sold becomes cost of goods sold on the income statement. The ending inventory for one accounting period becomes the beginning inventory for the next period. Part 2. The relationships between these various inventory amounts are brought together in the cost of goods sold equation. Beginning inventory plus purchases equals goods available for sale. Goods available for sale minus ending inventory equals cost of goods sold. Part 1. When inventory costs have changed during an accounting period, which inventory costs are treated as sold or remaining in inventory can turn profits into losses and cause companies to pay or save millions in taxes. So the question to answer is, what amount is recorded as cost of goods sold when inventory is sold? The answer depends on which specific goods we assume are sold. 4 generally accepted inventory costing methods are available for doing so. Specific identification, first in, first out, last in, first out, weighted average. Part 2. The 4 inventory costing methods are alternative ways to assign the total dollar amount of goods available for sale between ending inventory and costs of goods sold. First, let's look at the specific identification method. In this method, we know the specific cost of each unit that is sold. It is most commonly used in businesses that have low sales volume of high-dollar items, like car dealerships, exclusive jewelry stores, and custom builders. The choice of an inventory costing method is not based on physical flow of goods on and off the shelves. That is why they are called cost flow assumptions. A useful tool for representing inventory cost flow assumptions is a bin or container. Try visualizing these inventory costing methods as flows of inventory in and out of the bin. Following practice, we will apply the methods as if all purchases during the period take place before any sales and costs of goods sold are recorded. Now, let's look at an example of the first in, first out cost flow assumption method. When using first in, first out, we assign the older costs to the units sold. That leaves the more recent costs to be used to value ending inventory. In other words, the first in, first out method assumes that the first goods purchased, the first in, are the first goods sold. Take a minute and review this chart for the mousepad inventory for Computers Incorporated. We will use this data throughout our inventory examples so we can compare our results at the end. There are 1,200 units in ending inventory and 1,050 units sold during the period. First, let's use the first in, first out method to determine the cost of the 1,200 units in ending inventory. Remember, when we are using the first in, first out method, the costs of most recent purchases are in ending inventory. So, Let's start with the November 29th purchase and add units purchased until we account for the 1,200 units in ending inventory. We start with the 200 units from the November 29th purchase, and we keep adding layers of purchases until we reach 1,200 units in ending inventory. The total cost of our ending inventory is $6,695. Now we can start working on the cost of goods sold. Recall that we sold 1,050 units. Remember that when we use the first-in, first-out method, the cost of the first items in, the oldest items, is allocated to cost of goods sold. Let's look at the cost of goods sold layers on the next slide. As you can see, we used the first units in from the beginning inventory and then added 50 units from the January 3rd purchase to account for the 1,050 units sold. The cost of goods sold amounted to $5,515. Here is the completed inventory worksheet using the first-in, first-out method that shows the cost allocated to ending inventory and cost of goods sold. When using last-in, first-out, we assign the most recent costs to the units sold. That leaves the older costs to be used to value ending inventory. In other words, the last-in, first-out method assumes that the last goods purchased, the last in, are the first goods sold. Take a minute and review this chart for the mousepad inventory for Computers Incorporated. We used the same data earlier for the first-in, first-out example. Now, let's determine the cost of the 1,200 units in ending inventory using last-in, first-out. Remember that when we are using the last-in, first-out method, the costs of the oldest purchases are in ending inventory. So let's start with beginning inventory and add units purchased until we account for the 1,200 units in ending inventory. We start with the 1,000 units from the beginning inventory, and we keep adding layers of purchases until we reach 1,200 units in ending inventory. The total cost of our ending inventory is $6,310. Now we can start working on the cost of goods sold. Recall that we sold 1,050 units. Remember that when we use the last-in, first-out method, the cost of the last items in, the most recent items, is allocated to cost of goods sold. Let's look at the cost of goods sold layers on the next slide. As you can see, we used the last units in from the November 29th purchase and then added units from other purchases to account for the 1,050 units sold. The cost of goods sold amounted to $5,900. Here is the completed inventory worksheet using the last-in, first-out method to allocate costs to inventory and cost of goods sold. When using weighted average, also known as the average cost method, we assign the average cost of the goods available for sale to cost of goods sold. The average cost is determined by dividing the cost of goods available for sale by the units on hand. The average cost method uses the weighted average unit cost of the goods available for sale for both cost of goods sold and ending inventory. First, we need to compute the weighted average cost of the items in inventory. We do this by dividing the cost of goods available for sale of $12,210 by the total units in the inventory of 2,250. The average cost per unit is $5.42667. Next, we can compute the cost of ending inventory by multiplying 1,200 units times the average cost per unit of $5.42667. The cost of the ending inventory is $6,512. We can also compute the cost of goods sold by multiplying 1,050 units times the average cost per unit of $5.42667. The cost of goods sold is $5,698. This slide presents a comparison of the impact on the income statement of using the different inventory costing methods. Because prices change, inventory methods nearly always assign different cost amounts. Everything is the same in each example, except the amount of ending inventory and cost of goods sold, and the flow-through effects on income before income taxes, income tax expense, and net income. In periods of rising prices, of the three cost flow assumption methods, first in, first out will provide the lowest cost of goods sold amount. This is because it uses the older costs, which tend to be lower, to arrive at this amount. Last in, first out will provide the highest cost of goods sold amount. This is because it uses the most recent costs, which tend to be higher, to arrive at this amount. Weighted average will provide a cost of goods sold amount that falls between first in, first out and last in, first out. As you can see, the impact on net income is that first in, first out results in the highest net income, last in, first out results in the lowest net income, and weighted average results in net income that falls in the middle of these two. An advantage of weighted average is that it smooths out peaks and valleys in price changes that may occur during the period. First in, first out does a great job of valuing ending inventory at an approximate replacement cost. This is because first in, first out uses the most recent costs to value ending inventory. Last in, first out does a great job of matching current costs in cost of goods sold with current revenues. This is because last in, first out uses the most recent costs to determine cost of goods sold. Part 1. What motivates companies to choose different inventory costing methods? Most managers choose accounting methods based on two factors. 1. Net income effects. Managers prefer to report higher earnings for their companies. 2. Income tax effects. Managers prefer to pay the least amount of taxes allowed by law as late as possible. Any conflict between the two motives is normally resolved by choosing one accounting method for external financial statements and a different method for preparing its tax return. Part 2. The choice of inventory costing method must also consider the last in, first out conformity rule. This rule states that if last in, first out is used on the income tax return, it must also be used to calculate inventory and cost of goods sold for financial statements. Inventories should be measured initially at their purchase cost in conformity with the cost principle. When the goods remaining in ending inventory can be replaced with identical goods at a lower cost, however, the lower cost should be used as the inventory valuation. Lower of cost or market is a valuation method departing from the cost principle. It serves to recognize a loss when replacement cost or net realizable value drops below cost. Replacement cost is the current purchase price for identical goods. This departure from the cost principle is based on the conservatism constraint, which requires special care to avoid overstating assets and income. Under lower of cost or market, companies recognize a holding loss in the period in which replacement cost of an item drops rather than in the period in which the item is sold. The holding loss is the difference between the purchase cost and the lower replacement cost. It is added to the cost of goods sold of the period. To illustrate, assume that Dell Computer had the following in the current period ending inventory. The 1,000 Pentium chips should be recorded in the ending inventory at the current market value of $200 because it is lower than the cost of $250. Dell would make the journal entry illustrated that debits cost of goods sold for $50,000 and credits inventory for $50,000. Since the market price of the disk drives of $110 is higher than the original cost of $100, no write-down is necessary. Recognition of holding gains on inventory is not permitted by generally accepted accounting principles. As mentioned earlier, the primary goals of inventory management are to have sufficient quantities of high-quality inventory available to serve customers' needs while minimizing the costs of carrying inventory. The inventory turnover ratio is an important measure of the company's success in balancing these conflicting goals. The inventory turnover ratio is calculated as costs of goods sold divided by average inventory. Average inventory is the beginning inventory plus the ending inventory divided by 2. This ratio reflects how many times average inventory was produced and sold during the period. A higher ratio indicates that inventory moves more quickly, thus reducing storage and obsolescence costs. When companies expand production to meet increases in demand, this increases the amount of inventory reported on the balance sheet. A change in inventories can have a major effect on a company's cash flow from operations. Cost of goods sold on the income statement may be more or less than the amount of cash paid to suppliers during the period. Since most inventory is purchased on credit, reconciling cost of goods sold with cash paid to suppliers requires consideration of the changes in both the inventory and accounts payable accounts. When a net decrease in inventory for the period occurs, sales are greater than purchases, and thus the decrease must be added in computing cash flows from operations. When a net increase in inventory for the period occurs, sales are less than purchases, and thus the increase must be subtracted in computing cash flows from operations. When a net decrease in accounts payable for the period occurs, payments to suppliers are greater than new purchases, and thus the decrease must be subtracted in computing cash flows from operations. When a net increase in accounts payable for the period occurs, payments to suppliers are less than new purchases, and thus the increase must be added in computing cash flows from operations. Before meaningful comparisons can be made across companies, one company's statements have to be converted to a comparable basis. For inventory comparisons, making such a conversion is eased by the requirement that U.S. public companies using last-in, first-out also report beginning and ending inventory on a first-in, first-out basis if the first-in, first-out values are materially different. Review these computations that result in identifying the difference in cost of goods sold between last-in, first-out and first-in, first-out. You can adjust the inventory amounts on the balance sheet to first-in, first-out by substituting the first-in, first-out values disclosed in the notes to the financials. The methods of accounting for inventories discussed in this chapter are used in most major industrialized countries. In several countries, however, the last-in, first-out method is not generally used. These differences can create comparability problems when one attempts to compare companies across international borders. After cash, inventory is the second asset most vulnerable to theft. Efficient management of inventory is crucial to avoid stockouts and overstock situations. As a consequence, a number of control features focus on safeguarding inventories and providing up-to-date information for management decisions. Key among these are 1. Separation of responsibility for inventory accounting and physical handling of inventory. 2. Storage of inventory in a manner that protects from theft and damage. 3. Limiting access to inventory to authorized employees. 4. Maintaining perpetual inventory records. 5. Comparing perpetual records to periodic physical counts of inventory. In a perpetual inventory system, a detailed inventory record is maintained, recording each purchase and sale during the accounting period. This up-to-date record is maintained on a transaction-by-transaction basis. To this point in the text, all journal entries for purchase and sale transactions have been recorded using a perpetual inventory system. In a perpetual inventory system, purchase transactions are recorded directly in an inventory account. When each sale is recorded, a companion cost of goods sold entry is made, decreasing inventory and recording cost of goods sold. As a result, information on cost of goods sold and ending inventory is available on a continuous, perpetual basis. In a periodic inventory system, ending inventory and cost of goods sold are determined at the end of the accounting period based on a physical count. Cost of goods sold is calculated using the cost of goods sold equation. Take a minute to review this slide. It shows the comparison of a periodic inventory system and a perpetual inventory system. Beginning inventory is carried over from the prior period in both inventory systems. In a periodic system, purchases of inventory are accumulated in the purchases account, while in a perpetual system, purchases are accumulated in the inventory account. In a periodic system, ending inventory is measured by a physical count of the inventory on hand at the end of the period. In a perpetual system, the inventory record is continuously updated, so the information in the inventory account is always available. In a periodic system, cost of goods sold is computed as a residual amount at the end of the period. In a perpetual system, cost of goods sold is measured and recorded for every sale. Take a few minutes and review this chart. It shows the impact of inventory errors on the balance sheet and income statement. For example, if ending inventory is understated, assets on the balance sheet will be understated due to the understatement of the ending inventory balance. On the income statement, cost of goods sold will be overstated, and gross profit will be understated, which will result in an understatement of net income. An understatement of net income will result in an understatement of retained earnings in equity on the balance sheet. You will need to work through the other possible inventory errors to see the effect on the current period's balance sheet and income statement. Supplement A. LIFO liquidations. When a LIFO company sells more inventory than it purchases or manufactures, items from beginning inventory become part of cost of goods sold. This is called a LIFO liquidation. When inventory costs are rising, these lower cost items in beginning inventory produce a higher gross profit, higher taxable income, and higher taxes when they are sold. Companies must disclose the effects of LIFO liquidations in the notes when they are material. Many companies avoid LIFO liquidations and the accompanying increase in tax expense by purchasing sufficient quantities of inventory at year-end to ensure that ending inventory quantities are greater than or equal to beginning inventory quantities. Part 1. Supplement B. Additional issues in measuring purchases. Purchase returns and allowances are a reduction in the cost of purchases associated with unsatisfactory goods. Returned goods require a reduction in the cost of inventory purchases and the recording of a cash refund or a reduction in the liability to the vendor. Part 2. Purchase discounts are provided to customers as an incentive for them to pay early. Part 1. The credit period is the normal period of time the company allows for customers to extend their account receivable, typically 30 or 60 days. The discount period is a much shorter period of time, typically 10 or 15 days. If payment is received during the discount period, a discount may be taken. Purchases paid for within the discount period reduce the inventory account for the amount of the cash discount received. If payment is made after the discount period expires, then the full payment is due on or before the end of the credit period. Part 2. Purchase discount terms are typically written in a shorthand form as shown on this slide. This particular discount term would be read as 210 net 30. The first number represents the discount percentage. The second number represents the discount period. The letter N stands for the word net. The last number represents the entire credit period. In this case, if the customer pays within 10 days, then a 2% discount may be taken. If not, then all of the amount is due within 30 days. Supplement C. Comparison of perpetual and periodic inventory systems. Here are two transactions accounted for using the perpetual inventory system. The company has 800 units in beginning inventory at a unit cost of $50. On April 14th, the purchase is recorded as a debit to inventory and a credit to accounts payable. On November 30th, the sale is recorded in two entries. The first entry records the retail transaction between the customer and the company by debiting accounts receivable and crediting sales revenue for the sales or retail price of the goods sold. The second entry records the internal transaction at cost that transfers the cost of the inventory sold to cost of goods sold. This entry is a debit to cost of goods sold and a credit to inventory for the cost of the inventory sold. At December 31st, the company would use the cost of goods sold account balance on the income statement and the ending inventory account balance on the balance sheet. A physical count is still necessary to assess the accuracy of the perpetual records and identify theft and other forms of misuse. Here are 2 transactions accounted for using the periodic inventory system. The company has 800 units in beginning inventory at a unit cost of $50. On April 14, the purchase is recorded as a debit to purchases and a credit to accounts payable. On November 30th, the only entry required is the entry to record the retail transaction between the customer and the company by debiting accounts receivable and crediting sales revenue for the sales or retail price of the goods sold. At December 31st, the company would count the number of units on hand, compute the dollar valuation of the ending inventory, and compute and record the cost of goods sold. The first journal entry on December 31st transfers beginning inventory and purchases to cost of goods sold. The second entry reduces cost of goods sold and establishes the ending inventory balance. End of Chapter 7.